Hello, everybody. This time we are talking about the source of capital. Capital resources on the balance sheet are resources that a company can use to generate revenue and profits. Capital includes all the assets a business owns, including cash, equipment, property, and inventory. In addition, capital also includes other amounts of money that the company borrows from shareholders, investors, banks, or creditors. And then, how to access sources of capital for business. The first, capital markets. Capital markets act as hubs where savings and investments are exchanged. Suppliers provide the necessary funds, which are then accessed by various entities for a number of purposes. These markets are integral in facilitating the flow of capital and serve as efficient platforms for buying and selling securities. And then, second, traditional banks. Banks generally provide lower interest rates and longer repayment terms. However, their application process can be stringent with requirements for strong credit scores, substantial collateral, and detailed business plans. Traditional banks are best suited for established businesses with a solid financial history. And then, third, direct lending. Direct lending is a significant source of capital, especially for privately owned companies often backed by private equity sponsors. It involves the provision of privately negotiated loans or credit, typically senior in the capital structure made directly by non-bank lenders. And then fourth, alternative lenders. Alternative lending has emerged as a popular source of capital, especially for businesses that may not meet the strict criteria of traditional banks. These lenders offer various financing options like merchant cash advance, peer-to-peer loans, and online lending platforms. The application process is typically quicker and less rigorous with higher approval rates and faster funding. And then we move to the importance of diversifying capital sources. The first, risk mitigation. Relying on a single source of capital puts your business at risk. If that source decides to pull back the supply of capital, you could be left without the funds to make new loans. By diversifying your capital sources, you mitigate these risks, ensuring that you always have access to capital you need to fund your deals. And then second, more opportunities. By diversifying your capital sources, you open up new opportunities for your business. You can offer different loan products, provide larger loans, or expand into new markets knowing that you have the capital to back it up. And then, third, increase flexibility. Diversifying your capital sources gives you more flexibility to offer loan terms and interest rates that suit various strategies. If you have multiple sources of capital, you can negotiate better terms and rates, which can lead to increased profitability. And then we move to current methods of mobilizing capital. The first, initial contributed capital. To be able to establish a business, the owner, investor, or funder must spend a certain amount of capital to make the business legally qualified. This capital amount will be determined based on the provisions of law on business establishment. This source of capital has the advantage of not depending on external factors, but the disadvantage is that it is often limited, only accounting for about 20% to 30% of the entire enterprise's capital. And then second, mobilize capital from issuing shares. This is a form of large capital mobilization that helps businesses expand and develop quickly, carry out large-scale projects, as well as increase their ability to borrow capital. With this method, businesses do not have to pay principal, nor are they required to pay dividends if they do not make a profit. Third, capitalize from undivided profits. When a business retains a portion of its profits for reinvestment, shareholders will have increased equity ownership instead of dividends. This form has the advantage of having a great impact on the internal capital of the business, creating opportunities for higher profits in the following years. However, if businesses do not use this capital effectively, it will cause conflicts of interest between shareholders and managers, which can reduce the attractiveness of shares. And then fourth, mobilize capital from bank credit. Capital from bank credit is always considered an important source not only for the development of individual businesses, but also for the entire national economy. Besides, interest on loans from banks is a business expense and helps reduce a portion of income tax. So, compared to the other capital sources, mobilizing bank credit is considered the most optimal method. And then we move to qualifying for business financing. Qualifying for most forms of small business, especially financing, generally depends on factors like your personal and business creditworthiness, your business finances, whether it can repay the loan, and other application criteria. Storage can vary by lender and location. Approved applicants are offered loan terms, including an interest rate for access to funding based on application criteria. Some funding sources, including crowdfunding and business grants, may not have credit-based application requirements. Some business financing options are harder to qualify for than others. Business bank loans, for example, typically offer some of the lowest interest rates available for qualified small businesses, especially. Banks also require applicants to possess high minimum qualifications like stellar credit scores and a high annual income. Applying for this funding option also requires more paperwork and processing time than other methods like online term loans and business lines of credit. I think it is enough. Thanks